I mean, basically, what's happening in silver is that all liquidity is gone, and this is in large part because the supply of silver has been less than the demand for silver for at least the last 4 years. The difference has been made up basically by drawing down on silver stocks of various sorts. If the Silver Institute puts it in its table, if you like, as investment silver. So that gets drawn down, and then they can say that, at the bottom, if you take everything into account, we've got exactly the same figure for supply as we do for demand. But the reality is that it's in deficit and has been in deficit for the last 5 or 6 years. A lot of the supply, if you like, the excess supply, hasn't been investment so much, but it's been dishoarding by China. They've been prepared to try and put a lid on the silver price. I think there are two answers to this. Journalists and commentators are controlled, if you like, by the editorial, and editors have really very little interest in promoting stories about gold and silver. And I think, to be fair to editors, they're looking at their wider audience, and they're reflecting, if you like, the view of the wider audience. When it comes to individual opinions amongst journalists, I think they're equally at sea. I mean, there are some which are not. But bear in mind, it's 54 years now since gold was officially part of the monetary system. And we've had all the propaganda from America, and that does actually continue to influence people. You've also got the whole of the macroeconomic community, if you like, of economists and all the rest of it. Now, this denies the theories of sound money, which have been so well established over millennia. But it's different now, they say, and they have relegated classical economics and the importance of sound money, etc., into microeconomics. In other words, we don't bother with this little stuff, if you like. That's the way in which they try and persuade us and persuade themselves that gold is no longer part of the monetary system. The dollar is king. And they ignore the fact that currency is actually a balance sheet entry on a central bank's balance sheet. It is a liability of a central bank to the holder of the currency. And equally, bank reserves on the central bank's balance sheet are a central bank's liability to commercial banks. These are liabilities. I mean, it's not, this isn't money. I mean, as J.P. Morgan, the original John Pierpont Morgan, in evidence to Congress back in 1912, he said, gold is money, all else is credit. And he was right. It's still true today.
Modern macroeconomic thinking sidelines classical principles of sound money, relegating centuries-old wisdom to the academic footnotes of microeconomics. Economists claim it's different now, reinforcing the belief that the dollar is untouchable. Few acknowledge that currencies are liabilities on central bank balance sheets, essentially promises, not tangible money. This echoes J.P. Morgan's testimony to Congress in 1912, "Gold is money, everything else is credit." As global debt surges past $320 trillion and inflation erodes purchasing power, the cracks in the fiat system are widening. The more fragile the system becomes, the more relevant that century-old warning sounds.
I can't comment really on what methodology Naomi uses. I mean, she's a very thoughtful lady. I'd give her all the respect, if you like, for her understanding, if you like, of what is going on in markets generally. But I'm looking at this slightly differently. Standing back from the whole situation, I can see the end of the fiat-currency system. Now, if I'm right in that, then Naomi's forecasts are going to be, if you like, far, far too conservative. Because really what we're seeing is not gold and silver rising, but it is the purchasing power, the value, if you like, of fiat currencies declining. Now, we can see what's going to happen next year. The first thing that'll happen is that bond yields will start rising. And maybe ahead of that, maybe as a result of that, the equity bubble will burst. You will then get a slide which will look, I mean, it'll make 1929 look like a tea party, like a vicar's tea party, if you like. The consequences of that are that the collateral within the entire system will be declining in value quite rapidly, and banks will be foreclosing on margin debt. I mean, you've got FINRA's margin debt, which is entirely through brokers, incidentally. It's currently running at about 1.2 trillion. That will be foreclosed on. So we're talking about, I mean, that 1.2 trillion of borrowing probably backs something like, I don't know, 3 trillion of assets, something like that, in stock. They're certainly not in the bond market. They're in stocks. As well as that, of course, the banks have also loaned credit to hedge funds and similar financial institutions who go direct to the banks. They don't go and borrow from brokers. They go direct to the banks. I don't know how much that is. And then, of course, you've got the entire carry trade, which is probably another, we can only guess, 10 trillion, something like that.
If the current trajectory holds, the next phase will be rising bond yields, an event already hinted at in recent Treasury auctions and global sovereign debt markets. A surge in yields would pressure equities, potentially triggering a cascade far more violent than 1929 or 2008. With over $1.2 trillion in U.S. FINRA margin debt and trillions more borrowed by hedge funds and carry trade players, forced liquidations could become systemic. As collateral values fall, banks will tighten lending, accelerating the downturn. This is not gold or silver rising, it is fiat currencies weakening as the credit system begins to buckle under its own weight.
And what we have seen in silver in recent days is a destabilization, if you like, of derivative markets in silver. It's yet to happen in gold. But there are a whole number of things which are beginning to sort of rather implode, if you like. And the common root in this is something that you were asking in another question, and that is, what happens to the debt in the end of the fiat currency system? And that is that it loses its value, which means that bond yields rise, and they continue to rise. And consequently, you will get an enormous collapse in not just the value of financial assets, but also in the value of the currency itself, because the only thing governments can do is to try and rescue everything. And we saw with the great financial crisis back in 2008, the Fed's response was basically to write an open check for the entire system, which I reckoned was the potential liability at the time of some 13 trillion. Now, that was when a trillion was a lot of money. Well, it's not quite so much. So you can see that, these conditions, if I'm right about it, will mean that NOMI's forecasts are far, far too conservative. Far too conservative, because a collapse in the value of currency will be reflected in the price, if you like, of gold. I'm not saying that the value of gold will rise. I'm just saying the price and will reflect the collapse of the currencies. This is why I cannot guess what the figure will be. I cannot say it's going to be X percent or, we're likely to see at least another how many dollars on top of the price, whatever. I don't think that's the way to look at it. So I'm going to stick with my approach of not making a price forecast. So I'm sorry about that.
Silver is now signaling distress across the derivatives ecosystem. Physical supply has trailed demand for 5 consecutive years, with deficits masked by stock drawdowns and Chinese dishoarding. That era is ending. China, long a stabilizer in global silver flows, has now withdrawn exports entirely, implementing a formal export ban beginning January 1st. As physical availability shrinks, derivative markets continue trading enormous volumes that cannot be delivered. Open interest on COMEX is falling even as prices rise, a telltale sign that the move is not speculative. Instead, it signals a system struggling to meet physical obligations as liquidity evaporates.
I mean, basically what's happening in silver is that all liquidity is gone. And this is in large part because the supply of silver has been less than the demand for silver for at least the last 4 years. The difference has been made up basically by drawing down on silver stocks of various sorts. The Silver Institute puts it in its table, if you like, as investment silver. So that gets drawn down, and then they can say that, at the bottom, if you take everything into account, we've got exactly the same figure for supply as we do for demand. But the reality is that it's in deficit and has been in deficit for the last 5 or 6 years. A lot of the supply, if you like, the excess supply, hasn't been investment so much, but it's been dishoarding by China. They've been prepared to try and put a lid on the silver price by ensuring that manufacturers of things that use silver, like photovoltaic cells and things, do have access, even though China is the largest producer of photovoltaic cells itself. China has always had a very firm control over silver. Well, now what's happened is that China, first of all, has withdrawn from supplying the West. That's the first thing. And the second thing is that from January the 1st, the export of silver is banned from China. So you can see that this is creating a huge, great problem in the markets. Now, history of the derivative system, it was originally brought in and sanctioned by the US Treasury as a means of suppressing.
For decades, commodity derivatives allowed banks to suppress metal prices by redirecting investor demand into paper rather than physical. This system flourished when regulators classed commodities as unregulated investments, pushing fund managers toward equities and bonds. But now, the suppression mechanism is reversing. Massive derivative positions face mounting stress as participants demand real metal. London vaults are thinning, and Shanghai's silver inventories have fallen to crisis territory near 570 tons. As contracts unwind, demand shifts into physical at the very moment supply is constrained. The more the system strains, the higher the pressure on precious metal markets.
Prices of commodities, particularly gold and silver, particularly gold, by diverting demand away from bullion into paper bullion, if you like, bits of paper. And this sort of fitted in quite well with the regulatory situation which evolved in the early 1980s, whereby investments, regulated investments, were defined as stocks, shares, bonds, so on and so forth. But unregulated investments included gold, silver, and copper and other commodities. Because they were not regulated, it basically means that the compliance officers will limit what an investment manager can do in terms of investing in physical gold, physical silver, and so on and so forth. So what this meant was that there was a control on the price, particularly of gold and also silver and copper and oil and things like that, by the expansion of these derivatives, soaking up demand for them without people actually bothering to get the underlying metal. And so consequently, the prices of underlying metal didn't rise. What we are seeing in the silver market now, however, is the complete loss of liquidity. There is massive dealing going on in silver derivatives. But of course, rather like a tire hitting the road, there comes a point, if you like, where people actually want the physical. And that is beginning to happen. Consequently, in London, there's nothing to deliver, even though they've been dealing in huge quantities. And the squeeze on COMEX has been evidenced, if you like, by the fact that silver's shooting into new high ground, while at the same time open interest is declining. What the decline in open interest tells us is that the speculators are not buying it. They're not going for it at all. The price is rising not because of speculation or investors, if you like, buying it. It is rising because the system itself is close to default. There is also a shortage in Shanghai. And looking at the combined stocks of the Shanghai Gold Exchange and also the Shanghai Futures Exchange, that's fallen to around about 570 tons, which is seen as close to crisis level. 600 being, you don't want to see stocks less than 600. We're about 570. There's a little bit creeping back in. I saw overnight there's about 14 tons came in or was recorded as having come into the underlying bullion stocks. But it's still a very, very difficult situation.
Silver is the first domino, but gold is close behind. Both are behaving like Giffen goods, where higher prices fuel more demand and reduce supply. COMEX gold open interest has collapsed even as gold trades near historic highs, an extraordinary signal of structural stress. These pressures threaten not just metals markets, but the entire derivative universe, which spans hundreds of trillions in notional exposure. Counterparty risk, once theoretical, is becoming tangible. If key players fail, the fiat-based global financial architecture could face cascading failures. In that environment, gold and silver won't soar in value. Currencies will simply fall against them.
Now, the point about this is that the use of of derivatives to soak up demand for commodities, that story has now come to an end. And it's beginning to go into reverse. Now, just imagine you have got a large number of bullion banks, hedge funds, and all the rest of it who have positions one way or the other in derivatives. And these are now questioned as to their value. As that unwinds, then the demand is going to go into the physical. So you can see that as that contract on COMEX and also forwards in London begin to collapse, and it looks like that we're in the early days of that, then this in itself, purely in terms of substitution, is going to push up the silver price very, very substantially from here. So this is the importance of what we're seeing in silver. Now, if it's true in silver, it's not far behind being true in gold. Because again, if you look at open interest on COMEX, that's collapsed, while gold has been trading at close to the highest levels ever. This is an extraordinary situation. They're both becoming what have been described as Giffen goods. In other words, the normal laws of supply, demand, and price have been completely suspended. Instead, what happens is that as the price rises, it creates buyers and reduces supply, which pushes the price up even further.
Yeah.
And that's what we're seeing. And this is actually undermining. It started with silver. I think it's going to follow through into gold. I mean, all the indications are there that it will. It's beginning to undermine the most important derivative contracts in the whole of the derivative system. Now, you may think that this is an exaggeration, but bear in mind that the banks and all the rest of it who have these positions are counterparty risk the whole way across the entire derivative landscape. So what we're seeing is the potential failure, and certainly if we don't get an immediate failure, concerns that there will be a failure of derivative counterparties in the whole of that space. Now we're talking about trillions of notional value affected by this. So this is another aspect, if you like, of things that just seem to be going wrong at exactly the wrong moment, if you like.
Yeah.
So that's the importance, really, of what silver is telling us, I think.